Welcome back. You're watching Stock Watch with me, Simon Brown. Joining me to take your stock-related questions tonight, Ricus from PSG Hole and One Ruimsig, Gary Booysen from Rand Swiss. Please be sure to send your questions on email, stockwatch@bdtv.co.za or SMS 41392 or on X, #Stockwatch. Gents, thank you for your time. Let's start with that inflation number, 2.8%. Ricus, I was asking you when you bought your first house before we came on air, because you're old enough, Gary's too young. I bought mine in 98. Interestingly, 98 was the time when we had the biggest gap between prime and CPI. Surely the governor's got to get aggressive tomorrow.
Who's that for, Simon?
Sorry, Ricus, to you.
Okay. Yeah, no, I mean, it seems nonsensical to have that kind of gap. And I've been thinking he's been overly cautious, and surely, just compared to what's happening with global rates, there's room for improvement and more than just a 0.25, if you ask me.
Gary, rates tomorrow, MPC, 3 o'clock. Are we just going to get our 0.25?
Yeah, I think we're just going to get the 0.25. I don't think there's been any indication that the Reserve Bank is going to go for that the full 50 basis points. It would be a welcome surprise if they do. Certainly, I think asset prices will love it, and I don't think we'll see too much weakness in the rand. As you mentioned, the real interest rate differential between us and developed markets is significant. So I think there definitely is room for 50, but I think they're going to go 25. And I think the reason for that is if you look at the CPI number that came out today, as you said, 2.8%. Our inflation target is at 4.5%, but that's a lot of that is for food and fuel. If you go and look at the core number, which strips that off, that's at 3.9%. So still kind of below the midpoint of the target. But the one thing that we've got to take into consideration is that there are some base effects in this number as well. So when we look at the November and December figures, we expect it to go up a little bit. We've also had a little bit of a weakness in the rand currently. International food prices are starting to rise. They're up about 2% month to date as well. So I think there's a lot of argument that the next couple of CPI prints are going to be a little bit higher than where we are here, and this is to an extent a little bit of an anomaly. So I think that's what the Reserve Bank is going to look at. So I'm saying 25, but wouldn't it be great if we could get 50?
Yeah, and look, in the last MPC, their prediction for next year was 4.4. So let's be clear, they're expecting it to go higher. This is not surprising in that it came down. Let's move to some stocks. Gary, let's stay with you. Thungela Resources, question coming through. Is opportunity in the coal miners? The question was they prefer Thungela. Your thoughts on coal stocks?
Oh, it's difficult because obviously we had that massive running together, because of essentially the disruption to supply and kind of like almost the energy crisis that we had. And since we saw kind of like those lossy valuations, we've really been avoiding the stock at the moment. So you look at it, they are still in the coal space. When Thungela listed, it looked way too cheap, and you could kind of ignore all of the ESG concerns around coal production, etc. For now, we're kind of trading at the top of a band at the moment on Thungela. You're up at around 135 currently. This is up from just over 100. That seems to be where the channel is. I would say it's maybe a little bit expensive for entry at the moment. So I'd be looking more towards 100. But again, ESG concerns are real. Longer term, this for me is very much a trading stock, and it doesn't look particularly cheap. Remember, when you buy into a coal mining company like Thungela, you've got that kind of single commodity price exposure. So as energy supply moves around and supply and demand changes, it has huge impact on the stock. So not something that I'd hold in a portfolio longer term, but more trading opportunity stock. That's why I'm looking at technicals, and that's why I'd say I'd be trying to buy between kind of 105 and 110 rather than 135.
Ricus, Thungela, of course, single commodity, and Transnet.
Yes, and Transnet, and China, and tariffs. So there's a lot of wheels turning there. But as Gary said, it's not an investment; it's a trading opportunity. And I know what Gary is saying, top of the band. But if it does break out from that top of the band, I've got a price target of about 160 rand on it. So I think the next few days are going to be crucial. Let's see what happens with commodity prices in general. That's been under pressure because of China, and their stimulus not really stimulating. But it's gone flat from being in a long-term downtrend, and it's been sort of basic. And what I'm waiting for is that base to break out. But as Gary said, can fall back to 100, 105, good trading opportunity to buy in at that stage. Otherwise, if we start pushing past 140, 160 next target.
Ricus, we'll stay with you. RFG, Rhodes Food Group in the olden days, came out with results this morning. Not a bad set of numbers. Market liking it. A lot moving in the right place. Certainly been trending higher since, early 2023. Your take on RFG?
Yeah, it's a well-run company. I haven't taken a look at the numbers. Market likes it, obviously. And together with the results we've seen from things like Premium, Anglo Industries, quite a defensive sector, obviously, not a bad place to be in. And as far as operations are concerned, yeah, for a smaller sort of positioning, I won't be against that.
Gary, RFG, I mean, the numbers were good. They've got the international, they've got the local. Margins local were up. I think offshore margins were slightly squeezed. Your take on RFG?
Yeah, looking at also, I haven't gone through the numbers in detail, but we do have estimates on it. So I'm looking for kind of revenue growth of kind of like call it 12.5% for the full, 1 year out, and another 7% the year after that. But we are looking for a big recovery in earnings. But a lot of that, I think, has almost been accounted for in the share price rally that we've seen, in 2024. So RFG looking pretty good. As the business model, I mean, they've got some stiff competition, as Ricus was saying. There's some very high quality businesses in this space, but at the same time, not particularly expensive compared to those peers as well. So yeah, maybe an opportunity. We don't hold it in portfolios. So I don't know. It's I'd be again a little bit cautious after the share price run that we've seen so far. But also, you're not buying. It's not expensive. So if it fits your strategy, I wouldn't be against it. I'd probably say it's a whole.
Gary, let's stay with you. Boxer IPO, I think it closes Friday. A question came through. Are your guests applying for Boxer shares? And if you don't get, would you buy Pick and Pay? Because, of course, they will still hold 60%. Gary, Boxer, Pick and Pay, are you applying? Would you buy Pick and Pay instead?
No, we're not applying. So generally, the way that we treat listings, other than going and enjoying the event, is to really look at the volatility around the stock, because so often, I mean, if you look at the history of JSE IPOs, you generally, maybe we buy cars as an exception, you generally get a second bite at the cherry at very reasonable prices as well. So I think Boxer it's an exciting listing. There's no question about that. You really are taking kind of like Pick and Pay's crown jewel and listing it separately. The numbers look fantastic coming into the IPO, but you would expect it to look fantastic going to the IPO. Of course, they've done everything they can to make sure that this looks like the most attractive investment opportunity out there. I think that the space that they play in is very exciting, but can they take on ShopRite? Looking at just how entrenched ShopRite is in the market and a massive lead they have in terms of technology, supply chain management, etc. This is still coming out of the Pick and Pay stable. We've been very negative on Pick and Pay for many years, at this stage, I think we would prefer to see Boxer prove itself in the market before we buy. And if we miss the first 20, 30, 40%, so be it. Let's see how it operates as a standalone company first.
Yeah, I take your point. They did polish those numbers, man. They Brasso all over it. Ricus, your take on Boxer or Pick and Pay in the IPO? Have you applied for IPO?
No, and in order to save time, agree exactly with what Gary did for the same reason. You spoke about this on the 14th of November, so nothing to add.
Okay, nothing further to add there. Ricus, you've got a property stock coming up later, but Nippy Rockcastle question coming through around that. Should I be concerned with Europe looking a little bit tough? Your take on Nippy Rockcastle? They had some numbers out today, not looking too bad.
Yeah, numbers look okay, and if you take a look at the numbers, they also explicitly state that they're not factoring in risk of what's happening to the east of them. Yeah, it is concerning. They are right on the border, but let's say everything, well, I won't say goes well, but doesn't escalate. I still think they're in a very good territory as far as Poland is concerned. So I'm happy to hold that for the moment.
Gary, Nippy Rockcastle?
Yeah, I think Rick's right. You've got to look at the kind of macro concerns, although it is obviously in a NATO country. So while Russia has reduced its requirement to essentially counteract missile strikes with a nuclear deterrent, which is obviously going to be concerning, it's in a pretty good shape. Yeah. So, I mean, I was in Poland probably 3 years ago. And I mean, one thing I can say is that it's absolutely incredible to see the development and the thriving economy in a lot of these Eastern European countries. Yeah. So, obviously, looking at it, I mean, their rental collection at 99%, their LTV at, just under 30. They're really not excessively risky. Yeah, and I think the interest rate cycle is definitely going to help as well. If we get lower interest rates internationally, property portfolios like this tend to increase significantly. They have just completed a capital raise, and they've kind of raised more in terms of a green bond that they're essentially using to roll over some old debt as well. But yeah, also acquisitive, right-sizing the portfolio out of Serbia. They bought Magnolia Park now in Wrocław, also in Poland. And yeah, I think these Eastern European economies, they are thriving, and there is growth to be had there. And I think South African operators, we know how to build shopping centers. So I like the business, but yeah, also don't hold it in portfolios currently. Kind of have preferred property exposure.
Yeah, I take a point. What we do well in this country, many things. One of them, build properties, shopping centres. Gary, let's stay with you quickly before break. Astro, question come in, cleared their debt. Maize should be coming down, worth buying. I've said this before, the 10-year chart, you're basically buying it now what you could have got it for a decade ago. This is a trading stock.
Definitely a trading stock, because it's all related to those maize input prices and what happens with the tariff protection against dumping as well. So I mean, obviously spectacular numbers from the company, but also coming off a low base, as you said, pay down that debt. I think they paid it down in 10 months. I was listening to the CEO earlier, and yeah, I mean, obviously fantastic. It's not the kind of company that you want to have a lot of gearing inside, because obviously you are buffeted by so many external factors outside your control. But looking at it, they did benefit from obviously a better maize crop. If you look at what's happening at the moment, we have seen the maize price move up significantly. It's up to about 5,000, just under 5,000 a ton at the moment. The one interesting thing to note that I think maybe some people haven't picked up is that Astro actually hedges as well on their maize production. They've got some cover in at 4,000 a ton, so they are a little bit more insulated than the rest of, or at least some of the other poultry sector and the other poultry players. And by our estimate, and obviously we've got Anthony covering it for us, it is, from a cost point of view, probably in the best position of all the poultry stocks. So yeah, we like it. We hold it in portfolios, but yeah, it does add a lot of volatility to any portfolio. But when times are good, they are very, very good.
Ricus, we didn't have time to get to you on Astro before the break. Certainly as a trading stock, is it one you'll be trading into at this point?
Gosh, I've avoided chicken stocks like the plague. Plague being operative, because you get another bout of avian flu and everything goes to hell. Yeah, no, I just look at the share price in amazement, but it really is too volatile. If it's not costs that get you, it's new entrants to the market or dumping. There's such a number of factors out of control that, yeah, you can make good money out of it if you get your timing right. I don't have the confidence that my timing is that good.
Take a point on that. Ricus, we'll stay with you. Intel question coming through. Is it dead, or does it just look like it's dead?
But it certainly gives a very good appearance of being dead. They've got a lot of catch up to do. They are far beyond your other manufacturers, and there is a new strategy. We'll see where that is going to turn out well for them. But while that is happening, and while they're restructuring and trying to reposition themselves, fundamentally they look cheap on the numbers, but it's the strategy and the execution of it that bothers me going forward.
Gary, Intel, it once was the chip maker. Now, of course, that is Nvidia and others. I mean, is there hope? Do we need to see more data before we get excited here?
I don't know. It's definitely for me a spec buy. So we don't hold it in our global equity portfolio. We actually hold AMD and Nvidia instead, but we do hold it in our AI specific portfolio, so our future tech portfolio. And just full disclosure, after the fall, I did buy some at $20, and it's looking pretty good. But I went bottom picking, and it, as I said, very speculative at this stage. So I mean, remember Intel? I mean, it did hold essentially the lion's share of the PC market, but it just hasn't managed to capture the AI trend the same way as TSMC or Nvidia. But I think if you have a long time horizon, you've got to assume that Nvidia cannot hold it. I mean, obviously, we've got Nvidia results tonight, so we're going to see a lot of what happens in the semiconductor space. But you can't believe that Nvidia will perpetually be able to hold on to a monopoly. It's just not how economics works. And at some point, some of the other players are going to catch up. It might take 3 years, it might take 5 years. But is it going to be AMD? Is it going to be Intel? Maybe buy a spread of each of them. I really, as I said, I own in my own account from $20, and I'm quite happy to sit on them. So if you are looking for like I say, I think you can have patience, and I don't think that there are real problems within the business. It doesn't kind of match our multi-factor model to be included in our global equity portfolio. But for me, the turnaround plans, they are making the right noises. A spun off shares of Mobileye. I think they're starting to do the right things, but as Ricus says, it's going to be a long journey. Just markets are forward looking though, so the journey might be long, but as soon as the markets can see through that fog, that's when you'll get the share price re-rating. So I wouldn't wait too long, is what I'm saying.
Yeah, and they've got some stuff from the CHIPS Act in particular, because the Pentagon wants to buy American chips, and well, that is Intel. There isn't anyone else. Gary, staying with you, question came through around Anglo American. Is this stock looking attractive? Could we see another BHP offer? If my memory is right, that BHP can come back, I think, late this month with another offer. Anglo American, Gary?
Oh, it's a good question. So I tend to like Anglo American at the stage, and I would probably buy a spread of Anglo and BHP because you've got. I think I'm essentially trying to time the commodity price cycle, which is always pretty stupid. But you do get the sense the commodity prices have moderated, but we are moving into a world where policies from the likes of the Trump administration and elsewhere do seem like they're going to fuel inflation. So to buy into the diversified commodity miners, I think is not a bad thing. Obviously, as we get deals, so I think the rule is that they call it the put up or shut up rule.
Yeah.
And I think you have 6 months from the deal, and then before you can make another formal offer. And obviously, Anglo American, it is if you kind of chat to management and hear what management's saying, yes, they're almost trying to fend off the BHP advances, and they believe that they can, obviously release shareholder value, but they're very much doing exactly what BHP wanted to do anyway, spinning off Amplats, etc. And I mean, even, you do get the sense that the puzzle pieces are going to fit more cleanly for a deal later on. So whether there is a deal eventually or isn't, I mean, I don't know if I've got too much insight into that. I certainly don't think BHP is going to give up totally, and it might be soon, it might be in a while still. But fundamentally, whether there's a deal or not, I like both BHP and Anglo American. So based on kind of global macro factors. So I would probably be buying both.
Ricus, I mean, it's a 6-month rule. They can come back or not if they don't want to. Rumours that the BHP boss has been in Johannesburg. Anglo, looking attractive to you? Do you think there'll be another offer from BHP?
Okay, if memory serves, and I'm getting older, so who knows whether that's correct, but the last statement I read out of Bulletin is that they, quote unquote, have moved on. Whether that's just plain chess, who knows? But as Gary said, buy both and add some Glencore for extra spice if you believe that we're sitting with a possible commodity revival. Certainly over the past few weeks, on the back of the US election, there has been a little bit of interest in that sector, just taking a look at some of the ETFs that cover that spectrum, and also obviously when China started their monetary stimulus. So it's starting to grab attention, but I can't see a definite turn in that commodity cycle yet. So for the moment, I'm just sitting on the sidelines.
Yeah, and it was at the BHP AGM. Chairman said we've moved on, and the next day BHP said, well, maybe, but maybe not. They're basically hedging their bets in a sense. You talk around, Ricus, maybe the commodity cycle is turning. Would that apply to PGMs? What would be a pick in PGMs, or are you staying well away from a sector which has had a tough time? At some point it turns, I imagine. I just don't know when.
Still going sideways, still waiting for the prices itself to give me an indication that there's interest in that sector. If I were to go into a specific company, I would be going into Northern Platinum, just considering the assets they've got, the operations and the margins. So not too safe in the form of Anglos, or to get in the form of Implat, sort of a Goldilocks type of choice.
Gary, PGMs?
Yeah, I think steering clear for now. I think they're not expensive, but at the same time, you remember half of the I suppose PGM production goes towards autocatalytic converters, and at some point you do expect the transition to EVs. Now there's lots of arguments, based on the valuation, the shift is not going to happen as quickly as people think, and there's probably a discount. But we do know ultimately that we are going to be moving away from it, and there's going to have to be some massive I suppose, replacement, for PGM metals, or there's going to have to be a massive reduction in supply, which means less ounces produced by these mines. It means expenses putting shafts on care and maintenance. There's a big disruption coming to the sector, and I don't know, even at the kind of quite low valuations that we're seeing on the stock prices, if that fully reflects what's happening in the space. I'd be far more interested to look at something like Sibanye, which is at least starting to move towards, battery metals, lithium, etc. So cobalt and that. So I think, for me, I'd be very cautious. It's not something that we're allocating, massive amounts of capital to. Certainly not an Amplats or an Implats at this stage.
N91, of course, the spin out from Investec, results out this morning. Also a deal with Sanlam Investment Managers, where they're essentially going to take over the 400 billion portfolios from Sanlam. Gary, N91?
Not terrible for a cheap stock. So, I mean, assets under, I say not terrible, actually, that's horrible, but the assets under management up around 1% to 127 billion pounds. But this is in the context of an equity and bond market that has rallied incredibly hard, which you should have seen a lift in assets just because of that. Now the reason for it is because you saw 5.3 billion in outflows. Now that's never what you want to see from an asset manager. They're saying, despite the better environment, new business has been a lot slower as well. So headline earnings per share down kind of at least 12% to 7.8p. The dividend also down around 8%, which is really, I mean, the dividend is important for investors in 91. The Sanlam agreement becoming kind of their preferred manager, I think is pretty exciting. And that's one of the reasons that I would say that the stock, even though the results today weren't great, were, I think definitely something that I would probably hold in portfolios at this stage, and I would be buying. And also, if you compare it to something like Coronation, significantly cheaper just in earnings terms as well. So asset management is a wonderful business. Investment management is a wonderful business, and you do get the sense that 91. I mean, they've got the technology. I think they know what they're doing, and they're spending money in the right ways. I think we just got to give them a little bit of time, and I think the market is discounting them a little bit compared to the general sector. And so at these levels, I would be buying, even though the results weren't spectacular.
Ricus, we're out of time, so I'm not going to get your take on 91, but I do want your stock pick again with Resilient.
Yeah, it's just based on basically on what we're seeing happening with interest rates. They will benefit almost directly from that, considering their debt levels, first of all. Secondly, if you value them on a price to funds from operation at a pretty decent level. I like their exposure via Lighthouse to Spain, and considering their last results, great increase in annual revisions plus new growth, and they will benefit from lower interest rates. And we've already seen retail stocks running this morning, and they're obviously second in line to benefit from any kind of retail spend.
Gary, you're going with some complexity. You've got about 75 seconds to help us understand it.
So it's not as complex. So it's essentially an autocall. For those who don't know what an autocall is, it's a contingent payoff structure. That sounds complicated, but essentially you're going to get a fixed coupon as long as certain indices are positive. So the three indices that we're linking to are the NASDAQ, the Nikkei, and the Euro stocks. And all we need is these indices to be positive. If they're positive after 1 year, you will get current pricing. We priced this morning, we're going to get just over a 15% US dollar coupon. So in 1 year's time, we have an observation. We look at these three indices. If all of them are positive, you get 15% in US dollars. If they're not, we then have semi-annual observations. So every 6 months, we go back and we have a look at this. If all three are positive, we give you essentially 15% or 7 plus 7.5 plus 7.5 plus 7.5 all the way for 5 years. If one of these indices is negative after 5 years, we give you 35% capital protection. So we'll still give you all your money back unless one of the indices has fallen more than 35%. So that's the autocall. Basically, it's kind of a fixed income product. We've done the probabilities. And really, this should call within the first 3 years. The overwhelming probability is that it'll, if you look at back testing, that it'll call in the first 3 years. And you get a coupon that in US dollar terms is probably 50% higher than the S&P 500 average for far less market risk.
Yep, I take your point. That was perfectly described. Makes sense. That's all we have time for tonight. Stockwatch. Thanks to our guests, Ricus from PSG Hole and One Ruimsig, going with resilient Gary Booysen from Rand Swiss with an autocall. Up next, the close. Stay tuned.